There's a formula, and it basically runs the entire option market. In fact, you've probably heard of it by now. It's called the Black-Scholes Model. Everything from implied volatility to option Greeks to the price that you see on your screen can all be traced back to this model. And to use this model, you don't need to do any crazy math yourself. In fact, basically all brokerages and options tool have this embedded into the way they do their calculations. But you do need to understand why this model is important and how it connects to the overall game that we're playing here as option sellers. And that's what we're going to break down right now. By the way, if you want real trading education without all the fluff, click the subscribe button. I drop videos like this multiple times each week. So what is Black-Scholes? Well, basically, it's a pricing model that can be used to either calculate the implied volatility of an option or the price of the option. You can substitute in either of those variables. It really looks at 5 key components to do this calculation. It looks at the price or the implied volatility of an option, the strike price, the days to expiration, dividends if there are any, and the risk-free rate. And with those inputs, you can basically spit out either the price of the option or the implied volatility. And like I said at the start, you basically never have to calculate this yourself. Every brokerage, every volatility tool, they're all running this formula behind the scenes on your behalf. So the question becomes, if they're running the calculation for me, then why do I even need to know this? Like, sure, it's there, who cares? Well, the reason you want to understand how this formula works is because you can use this formula to your advantage to figure out how much edge your trades have if you have your own opinion of what volatility is worth. Let me give you an example to make this really clear. Let's say you're looking to sell a call option on Apple and you decide on the 200 strike 30-day to expiration call. For simplicity's sake, we will just say that there's no dividends and the risk-free rate is basically 0. You take a look at the option chain and you see that the 200 strike call is trading at 30% implied volatility and trading right now for $5. Now let's say you've done some savvy work and the reason you're trying to sell this call option is that you believe the realized volatility or the fair value for that option is actually 15% implied volatility, not 30% like the market's implying. Well, what you can do now that you understand how the Black-Scholes formula works is that you could substitute in that 15% number into the formula, replacing that 30% number that was originally used by the market, and you can calculate what your fair value for that option is. That $5 call option, after you substitute in your own value, maybe it's worth $2.50. Since you now have a fair value number at that $2.50 mark, you have an idea of how much profit you expect to make on this trade. And you can make a fair evaluation of if that margin is enough that you're willing to take on the risk of the position. It helps you make better decisions about your bid-ask spread and fills, right? If the market's really illiquid and there's a chance that you actually get filled near your fair value, well then obviously you just don't take the trade anymore. But by knowing how the Black-Scholes formula works, you're able to substitute in your own opinion of where implied volatility should be, calculate your own value of what the option should be worth if your forecasting is correct, and by doing this, it gives you a much clearer line of sight into what your trade is and how much money you should expect to make by running your strategy. That was a lot of words, so if you have questions, drop them in the comments. I reply to everyone, so I'll definitely help you out. Just think of the Black-Scholes model as your baseline. Now, there's one other benefit to the Black-Scholes model, and really, I guess this is more of a benefit of implied volatility, but we have to thank the Black-Scholes model for this. It's that it gives us a common language to speak about all options with. The Black-Scholes model lets us calculate implied volatility no matter whatever price an option's trading at. Without it, imagine you're trying to compare an option on a penny stock and an option on Apple. The penny stock option might be trading at $1 and the Apple option might be trading at $5. Without the Black-Scholes model, you might think that the Apple option is more expensive than the penny stock option. But by being able to convert it to implied volatility using the Black-Scholes model, we all of a sudden realize that maybe this penny stock option is trading at 250% implied volatility because as a percentage of the underlying share price, that $1 can be a lot, right? If it's a dollar stock, that's implying a 100% move. Whereas the option on Apple is maybe only implying 15 or 20% annualized volatility. So we really have this formula to thank for the entire way we look at the world of options. And now here's an even cooler part. At Predicting Alpha, we take this even further. We use this Black-Scholes model not just to calculate the implied volatility, but to go a step further and calculate the variance risk premium itself, which is the average spread between implied and realized volatility, aka how much money we're making on average for taking a certain trade. This becomes the backbone for all the backtesting we do, the strategies we run, and effectively why our members are able to trade with positive expected value. Being able to do all these calculations allows us to build scans, create analytic dashboards, and ultimately find trades that we should be including in our portfolio. So yeah, ultimately, this Black-Scholes model, it's why people talk about things in terms of volatility and not dollars. It's allowed us to compare the options for tickers that are trading at wildly different prices and do an apples-to-apples comparison comparison to make sure that we're doing it right, to make sure that we're not misunderstanding what we're seeing. And then beyond that, it actually allows us to substitute in our own opinions of where implied volatility should be so that we can calculate what our expected value on our trades are. So yeah, this formula is just the engine under the hood of all options trading, really. Knowing this formula gives you the foundation for understanding really everything else in this world. Variance risk premium, the Greeks, the price of options, all of it. And one last thing I will leave you with here is, if this has been a very theoretical video for you, don't get too bogged down by it. At the end of the day, this calculation is done for you by basically everywhere you're going to be using to trade options. You just want to understand the reason this formula is important, some of the cool little things it's enabled us to do, and then really you just want to get out there and focus on those things. And that's really what we cover in basically every other video here on the channel. So if you want more education like this, click the subscribe button. And if you're ready to start trading with an edge, take the free trial in the description below. All right, everyone, I'll see you in the next one.